Hello, everyone, and welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. So today I want to bring everyone an update on New York Community Bank. A couple of weeks ago, I did an episode just trying to update everybody and let everybody know what was going on with this bank. It's a big issue. It's a big issue right now. I mean, given what happened with the banking crisis that occurred in the spring of last year, we now have New York Community Bank that's been on the ropes here for the last, 3-4 weeks. And what could happen is this, in other words, could this be the first domino that falls that starts to cause a failure of several other community banks or regional banks, just as we saw in the spring of last year? So that being said, I was going to bring everybody an update on this last week, but I wanted to wait off. I've been following, banking and finance for a long time, and I just had a gut feeling that, I'm just going to wait on this another week. I think a lot of stuff is going to happen, and sure enough, they did not disappoint. So I'm going to take everybody through the week that was at New York Community Bank, and then I'm going to go over the news of the last couple of weeks in a little bit more detail through a number of articles and just try to bring everybody up to speed on what's going on. So starting on Monday, March 4th, several analysts downgraded New York Community Bank after the bank disclosed the resignation of CEO Thomas Kamenji and material weaknesses in internal controls related to an internal loan review on February 29th. Piper Sandler analyst Mark Fitzgibbon downgraded the bank to neutral from overweight and lowered his price target to $5 from $8 following the company's announcement. On the same day, Fitch Ratings downgraded the company and its bank subsidiary, Flagstar Bank, to BB+/B from BBB-/F3 after reassessing the company's risk profile, Reuters reported. Morningstar DBRS also cut the company's credit rating, citing outsized exposure to commercial real estate, according to the report. So we kick off on Monday with a whole bunch of downgrades across the board. And now we go in. So then some interesting remarks. So the CEO of PNC Financial, and I'll kind of get to this in a minute when we're going through the articles, but he basically talks more about how the failure of Silicon Valley Bank and some of the banks last year, and even the issues with New York Community Bank, are more related to uneven regulation as opposed to some of the other issues that we saw. And I don't necessarily concur with this, but we'll get back to that in a minute. So, okay, now we get into Thursday. So institutional investors and certain members of New York Community Bancorp's management will make over a $1 billion equity investment in the company that includes more than $450 million from Liberty Strategic Capital, $250 million from Hudson Bay Capital Management, and $200 million from Reverse Capital Partners. As part of the transaction, the company said in a news release, in connection with the investment, Joseph Otting, former U.S. Controller of the Currency, the OCC, will assume the CEO role and join the board with former Treasury Secretary Steve Mnuchin. Hudson Bay's Alan Pawlowski and Reverence Capital managing partner Milton Berlinski as new members. Citadel Securities LLC is also an investor, the company says. So they get downgraded. The company stock starts to completely plunge here over Tuesday and Wednesday. And by the time you get to Thursday, this is basically called a bailout. Okay. This is a bailout. I mean, investors are coming in now, injecting $1 billion in capital into this bank to try to save it here. And they tossed out the CEO that had come in. He's still chairman of the board, but this gentleman who tried to take over CEO, he basically got pushed out, and they brought in Joseph Otting, who is kind of it was former OCC, but very highly experienced guy who's been around banking for a very long time. Obviously has a huge background in bank regulation and oversight, really knows the inner workings of banks. So they, due to the issue with internal controls that basically ended up forcing out the previous CEO, they undoubtedly brought in Joseph because they want to try to really dig into what's going on here and really try to stabilize the situation. And they're hoping that he's the guy that can kind of bring confidence. So, okay, so then we get to Friday. So yesterday morning, so New York Community Bancorp unit Flagstar Bank received a stable trend, though lower credit ratings from Morningstar DBRS and Moody's change of review direction to upgrade from downgrade following a management change and fresh capital infusion of $1 billion from high-profile and experienced investors. Morningstar said the capital raise should help restore confidence in the companies. Moody's earlier reduced New York Community Bank's credit rating to junk after a slew of unexpected adverse announcements, including significant losses in the fourth quarter of 2023 due to bad property loans. So there you have it. So basically, the upgrades are kind of a little uneven. I think a lot of the people out there like Moody's and Morningstar, DBRS. I mean, they're I think it probably place a stable hold on this right now. Basically, say, all right, we're gonna kind of wait to see how this shakes out. But you can obviously tell that this is a situation where the performance of this bank is making a lot of people very uneasy right now. A lot of people are looking at this, and undoubtedly behind the scenes, a lot of regulators reached out to a lot of investors here and said, hey, we can't afford to let this bank fail. We can't afford to let this bank become a domino that starts a cascading effect with other regional banks. So they're trying to contain this right now. They brought in all these heavy hitters, a lot of big investors put in. I mean, this is what you call a major show of force, putting $1 billion into this bank to basically rescue it. That's a big deal. I mean, that's a big bailout. So with that being said, so let's just kind of run through the news of how this kind of unfolded here over the last couple of weeks here. So going back to February 12th, New York Community Bank commercial real estate exposure prompts broader concerns over the banking industry. Like I just said, regulators behind the scenes. New York Community Bancorp went from a crisis winner to banking's next worry. Now we go on to February 13th. New York Community, other officers, lenders report continued pain in the fourth quarter of 2023. So nearly 40% of New York Community Bancorp's loans on commercial real estate office properties were criticized as of the 2023 fourth quarter, but the company is not alone in experiencing headwinds in the sector. 40%. 40% of their loans on commercial real estate office properties were criticized, meaning they're bad, they're in trouble. That's just crazy. And they basically have a $3.4 billion loan portfolio of office loans right now, representing 3.9% of gross loans at the end of the quarter. That's a big book. That's a big book of commercial real estate right there. So moving to February 13th. So tougher rent laws are behind the trouble at New York Community Bank, as per the Wall Street Journal. So let's see here. Many of these loans were made when developers had more flexibility to upgrade rent stabilizing units and then boost the rent to market rate or convert them to condominiums. In 2019, new laws capped the amounts that landlords can raise rents at these properties. Though these buildings could still deliver steady returns, business plans that were based on steeper rent increases no longer penciled out. Property values started to plummet. So in other words, they are somewhat hamstrung on their apartment buildings because of these basically rent laws in New York City, which basically say that, you can't, you can only charge so much and that's it. You can't raise the rent. So there's an issue right there. So continuing on. So growing pains left New York Community Bancorp vulnerable. Not growing pains, buying a ridiculously crappy loan portfolio is what led them to have problems there. So, and we can see from this article, their stock price, dramatically plummeted from, just over the course of the early to mid-February. Okay, then we get to February 16th. So now Jacobs Asset Management LLC substantially increased its stake in New York Community Bancorp in the quarter before the company faced a massive sell-off after reporting its recent financial results. So in the fourth quarter, basically Jacobs Asset Management, they had invested a substantial amount of money into basically the New York Community Bancorp, not knowing that they were about to present this giant loss in the fourth quarter. So then here we go. Now we get to February 21st. So New York Community read across puts spotlight on commercial CRA and growing regionals. So New York Community Bancorp Inc.'s recent woes have revived fears over the impact of high interest rates on the financial sector and intensified focus on two groups in particular. So banks with heavy exposure to commercial real estate loans and banks graduating into size categories subject to tougher standards. What they're talking about is, so New York Community characterized a net interest margin depressing liquidity build and other moves as necessary steps to catch up with norms at large peers. Data shows that banks approaching the 100 billion threshold broadly have lower liquidity levels and credit loss reserve coverage than banks in the next size tier. The bank's reserve build also underscores strains on office loans and risks that banks face after exposure to multifamily loans. So again, they're talking about that $100 billion threshold and how when you cross that threshold, so there are a couple of big thresholds in banking. When you cross the $1 billion mark, that certain regulation kicks in. When you cross the $10 billion mark, certain thresholds kick in. When you cross 50 billion, and then when you cross 100 billion, they're more and more basically regulation oversight kicks in as you run through these things. So now, there's a concern there because of the higher interest rates, because of the regulation and things that they're going to have to get to. So now we begin to get to February 29th. So now here's where some of the other kind of bigger things started happening here. So we had, this gentleman named Alexandro Danello. He was basically the chairman of the company, and then he got named CEO. And basically, so he was going to continue to serve as the executive chairman and the CEO. Their former CEO, Kangemi, he resigned because, like I said, the issues with the internal controls, the loan portfolio, the other stuff that was going on there. And again, more news on Thursday, February 29th. They basically came out talking about that New York, they revised its previously announced unaudited financial results for the quarter and fiscal year ended December 2022. And so they were making adjustments for goodwill impairment and certain measurements. Making adjustments to their financial statements. So now we get to March 1st. New York Community Bank, Republic First woes reignite fears about regional banks. I kind of talked about Republic First in an episode last week. So, but basically, New York Community Bancorp shares were falling more than 20%. So, New York Community Bancorp closed at its lowest level since 1997. The bank disclosed late Thursday that management had identified material weakness in internal controls related to the way it monitors and assesses risk in its loan books. Those loans have been under scrutiny because of the bank's high exposure to commercial real estate that has fallen in value. The language is particularly troubling, said Steve Moss, a director at Raymond James. That creates a lot of risk and uncertainty. So, and now we get to Tuesday, March 5th, liquidity crunch. New York Community Bank's woes show uneven regulation. So, and this is from the PNC Bank's CEO, who basically said so he was speaking at a panel, and he basically said that, hey, the main lesson that he learned was that regulation is uneven, and that though management of those banks was bad, they took many risks. Regulators didn't do their jobs, do I agree with this? No, not necessarily. I think there were bigger issues there. If you look at my episodes I did on crypto, the crypto series and cryptocurrency, and how the crypto crash of 2022 led into the banking crisis and the crash of 2023, you will see how the main banks that were involved in that were crypto banks. They were crypto deposits. They were doing highly risky, highly questionable things, which ultimately led to them getting in trouble. There were other factors, obviously, that bared a pretty big burden as well in terms of the unrealized losses on the bank bond portfolios, other things that were going on, obviously, and then obviously as part of the toxic mix, bad management. And then the lack of oversight from some regulators in that situation also played a role in that. So then we get to too many eggs in the Fed pivot basket. So the value of New York Community Bank's multifamily loan portfolio is uncertain because it straddles an insane intersection of New York's socialistic rent control laws and the Fed's decision to keep interest rates near zero for years. While NCB's portfolio issues may be unique to New York area lenders, I expect regulatory pressure to escalate this year regarding loan grading and in some instances capital. So kind of hitting out at some of the Fed's work and then some of the things going on there. So New York Community Bancorp announces capital raise, new CEO as stock swings wildly. So a group of institutional investors and certain members of New York Community Bancorp's management will make a combined investment of more than $1 billion in the company, which will add 4 new board members and replace its CEO. And we kind of talked about that, the new appointments and what was going on there. And then going in again, more on this was now we're at March 6th, a little bit more on March 6th. So New York Community Bank's woes intensifying fears of crossing the $100 billion threshold, which we talked about. Now we're at Thursday, March 7th. New York Community Bank's apartment loans aren't a problem, said Steve Mnuchin. So in a Thursday morning call, following Wednesday's rescue deal by former Treasury Secretary Steve Mnuchin, New York Community Bank told investors that the $1 billion cash infusion will bring its capital up to 10.3% of assets compared to other large regional banks. News of the deal also stemmed a brief Wednesday run on deposits. New York City Bank Chairman Sandro Dinello told listeners up through Tuesday, he said the New York area lenders deposited had dipped 5%. The bank stock was up 11% in early Thursday morning trading to $3.85 after the analysts called with Dinello and New York City Community Bank's new chief executive, Joseph Otting. Then Mnuchin went on CNBC to explain why he's putting 12% of his Liberty Strategic Capital's private equity funds into New York Community Bank. This is a great business. Known well for a long period of time. It's a top 20 bank in the U.S., and it's got a great branch network. Over 80% of its deposits are insured, so it has a very stable deposit base. So again, I mean, this was a marketing campaign about the bailout to reassure everybody that everything was fine. So again, Monday morning comes. You have all these downgrades. Tuesday morning, and they say it right here, you literally started to have a run on the bank. Customers were very nervous. The bank stock was collapsing, had fallen down to below $4 a share. People are going in, they're starting to pull their money out. I mean, this bank was, I really think this bank was a couple of days away from the death knell. And that's what forced a lot of pressure to go out there and get these investors to come in, put this $1 billion in there, and then basically do this big marketing campaign. And then finally, we get to Friday. New York Community's capital raise buys time for the cleanup. $1 billion capital infusion and leadership overhaul helps staunch the deteriorating situation in New York Community Bancorp, and now the investment community awaits the company's next move. So we're going to have to continue to watch and see kind of what happens with this crazy roller coaster and how this continues to unfold. Now they made $1 billion investment in this bank, so is that going to be enough here? We shall see. Like I said before, it's a pretty sizable. I mean, it's a $3.4 billion office portfolio, just with commercial office properties, of which 40% have been criticized, meaning that they've got big problems. Is $1 billion going to be enough to stem that deterioration? I don't know. We'll see. We'll have to see over time. So, needless to say, I'm watching this like a hawk, and I will continue to bring everybody updates as I see things unfold, as I see things happen, and so. We'll continue to keep an eye on it and see what goes on here. And we'll continue to see if this is the canary in the coal mine, as it were. So, but anyway, but hey, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. You can always check us out on YouTube, Rumble, and all major podcast platforms. And I will be back to talk to everybody again real soon. Thanks a lot.